This is Tom Nunemaker with Capital Discussions. This is the recording for the roundtable from September 4th, 2014, with guest Michael Benklifa. The recording was actually started about 6 minutes after the presentation. WebEx had a new format and the recording button was a little different than normal, so that was my fault. Sorry about that. Now, what you did miss was the disclaimer, which I'm not going to read the whole thing. It's just high level. Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only, and options involves risks and are not suitable for all investors. So with that disclaimer out of the way, then we talked a little bit together about Michael's background, having written the 2 books that he did, and he has enjoyed the opportunities that's given him to speak and to meet other option traders. He had an RIA, and now it's a hedge fund, Preston Crest Capital Management. And he was just getting into the presentation when the recording started, and I'll stop here and we'll pick up with the presentation. So thanks a lot. Enjoy.
With no graph, is this going up or is this going down? You have no idea. But that's what price is. It's just that. What if you had more prices, right? Let's talk about what we know and what we don't know. So what do you know about, what would you rather trade? What would you rather trade? Would you rather trade what you know or what you don't know? I'm of the school that I'd rather trade what I know. Now, what I know is not based on what I'll put it this way. It's not what I think I know. I'm just going with what the market tells me. That's what I know. When you're trading stocks, you're trading what you don't know. You're assuming that the stock is going up for a specific reason, and you'll never really know if you nailed the reason on the head. So right now, Apple is the big thing. They're coming out with the iPhone 6. You think the stock is going to go up, but everybody knows iPhone 6 is coming out. So what do you know that nobody else knows? What's not reflected in the price? So all things being equal, my goal was always to find let me find some absolutes. Let me find something that I can find that I know versus let me trade what I do know instead of trading what I don't know. Let me see if I can trade where I can agree with the market rather than if I disagree with the market. Okay? People have to keep in mind that there's 2 separate markets. There's the stock market, and then there's the options market. They're not the same. When people say you can't beat the stock market, I agree. But can you beat the stock market with the options market? They're different animals. And yes, you can beat the stock market with the options market because they're different markets. They're apples and oranges. They don't compare. So here's an example. Here's a stock that was expiring. Okay, this particular stock, so I'm not going to tell you what stock it is because it really doesn't matter, actually. This stock has weekly expirations and monthly expirations. So I'm looking at this, and it expires in 11 days. So if we look at the 95 call and the 95 put, they're both selling for about $275, right? So
Yep.
We're looking at about what, $5.50 for the 2 of them. So really, if you bought the call and the put, you would need the market to move more than $5.50 in order to make money on this trade. Right? That's by expiration in the next 11 days. But more importantly, look at how many prices there are. Each price be it on the call side or the put side, is a piece of information. When you're buying a stock, you've only got that one piece of information. That's it. You've got the price of the stock. This is people putting actual bets on where the market's going to be. So if you're a seller of a call option at $95 and you price it at $2.76, you're pricing it in such a way that you don't want to lose. So you're essentially, the seller of that call option is the house. The buyer of that call option is the bettor. He's betting that it's going to move more than $2.76 on the call side. But he's got to get it right. He's got to get a number of things right. He has to get right the direction, he's got to get right the distance, and he's got to get right the timing in order to make money on this trade. So this is all, here you have a lot of information. Now we have even more information. So we have on the same pricing, on the same prices of those options, what we have is the implied volatility, which is basically, implied volatility is, for me, it's the black box of option pricing. Because we know when an option expires, we know the interest rates, we know the current price of the stock, we know a lot of information, but we don't, the piece we don't know is the volatility. It's what we call volatility. It's the fear. It's what we don't know. And so here, it's, you know, at the 95 call, it's at 44%. I added a few other columns here showing you the time premium. So for the 95 call, it's 276. That's the price of the, you know, that's how much you're paying to have the right to buy that call. The probability of being in the money is almost 46%. And the probability of touching that price of being in 90 and hitting the 95, because remember the actual price is below 95, is 76%. So this is information. This is a lot of information. You can buy and sell options on this whole table of information. When you look at a stock, it's like one cell of a spreadsheet. When you're trading options, you've got this. This is just one picture of one weekly of the option. We can expand this. And we've got weeklies. And we've got monthlies. So we have three weeklies here and one monthly on this option, the options on this stock. And to me, this is just a treasure trove of information. Again, you're looking at a stock price, and it's 50-50 bet. You don't know anything more than anybody else does. But the options market is telling you stuff. It's telling you a lot of stuff. It's telling you where it thinks the price is going to go over the next 3 weeks, 4 weeks, months, how far it's going to move. That, to me, is when I was introduced kind of to the options world, I found this to be terrific. And in fact, this particular program will show you everything that's in red is kind of like one standard deviation away. And everything that's in green is in 2 standard deviations away. So that's even more information. So we have probabilities, we've got pricing up and down the scale of the stock. We have pricing across time. So not just in this month vertically, but horizontally. And in this particular case, I wanted to point out something interesting. There is, on this weekly option, so we'll take a look at the 95 call, which is selling at 276. It has a mid-implied volatility of 44.5%, 44.4%. But look at the following weeks. 34.4, 30, 28.3. Why is the implied volatility so high all of a sudden for this option? Why is it so skewed here? And that's information. It's kind of something that we have to investigate because the market's telling us something. Because look at what we're talking about. Is the market saying that in 11 days, they think it's going to move $2.76, but in 18 days, it'll move $2.50. There's not much difference there over the 2-week period. So, but it's looking at a potentially bigger move in the short term than in the long term. So what do options traders look at? So far, I haven't shown you any stock charts. I haven't told you what the stock is yet. What I do look for are things like this. The implied volatility of an option is basically what the market's best guess of what they think the potential move of the stock price is going to be. The statistical volatility of the option is really the market's, what actually did happen. And when you see a difference between the two, like this, we have the blue line over the red line, it's showing that the option pricing is historically overpriced. The people who sell options are selling them at a higher price than what actually happens. And that's a good thing if you're a seller. If you're a buyer, that's a bad thing because if you're buying at the red line, but you're paying the blue line, that's not a good thing because that means it has to move that much in order to make money. So I circled these 4 areas, just eyeballing it. And you know what these 4 areas represent? These are earnings. What happens when earnings, right before an earnings announcement comes out for a stock? Typically, the stock itself will do nothing. It'll just kind of like sit there because people don't know what's going to happen. So much like people, much like in the theater, what goes on behind the stage is, much more boisterous. And what's going on behind the scenes in the options market is craziness. The prices are skyrocketing because people are betting, is the stock going to go up? Is the stock going to go down? And the pricing starts to skyrocket because of all the uncertainty. And that's what you see, is that you see right before earnings, the pricing just goes up and up and up. And right after earnings come out, what happens? The uncertainty disappears. We now know what the earnings is, and we know that volatility will collapse. And when volatility collapses, option prices collapse as well, because that's what option pricing is based on, volatility. So there are different strategies for different areas, different timings of the earnings cycle. And I use the earnings cycle not so much as to say this is what you must do. It's really, I'm using earnings as a way of understanding, of approaching options to better understand how one approaches options. So for instance, what are strategies that do well when you know volatility is going to go up? So a calendar trade where you might sell an option this month and buy one next month, that trade, if volatility goes up, the next month's options might go up higher, and you might make more money as you get closer to it, to earnings reports. And straddles, people tend to buy straddles, buy at the money calls and at the money puts right before earnings, hoping for a really big move, but usually they don't make money on those trades. But if you buy those straddles early enough, sometimes the big move happens before the earnings come out, and you get advantage of that as well. So this is the next day. So what happens is you can see the 95 calls which we're selling at $2.60 are now $1.99. The mid-implied volatility has dropped from 44 to 20. The volatility of all the options collapsed. The pricing has collapsed across the board for the option in one day. In one day. See, when you have a stock price right before earnings, there's a number of things that can happen. The price can go up, it goes sideways, it goes down. And you really don't know. So you go into the trade kind of blind. It's just a bet. With an options price action, you know the volatility will go up and will go down. So you have to structure your trade accordingly, like to take advantage of that scenario as much as possible. No guarantees that you'll be successful, but it's all about probabilities, as we saw in the charts. So this is the trade before the earnings came out. This is what we call a condor trade. And in the condor trade, we have, I'm sure, you still there? Make sure everything's good.
Yeah, I'm here.
Yeah, okay, good. Yeah, in the condor trade, we have, I took a probability earlier, probability being in the money. What I did was I didn't take the weekly, I took the monthly. And I said, let's sell 100 of the market was at 95. I was priced at 265. So the call was saying people were betting it wasn't going to go more than $2.65. I sell $10 away. On the put side, I also sell $10 away. And I cover it by buying puts. I buy on the other side, so I limit my risk, not infinite in either direction. This is what the chart looks like. As long as the trade stays in this range over time, it's profitable within this range over X number of period of time, which in this case is just 25 days. What happens the next day? So here we go. Here's the trade. And by the way, ta-da, it was Apple. Anybody was curious? So this is the trade. We put out $50,000. We got $4,200 of credit. And this is commissions and stuff and bid ask. And the next day, lo and behold, look, it only moves $2.50. So it says right here. Oops, sorry. Scott, I'm going the wrong way with this. Hold on a second. Sorry. Yeah, click too much there. So look at this. So you got $4,200 of cash. Look at the probabilities. So the probability in the money is 1.5%, 2.2%. These are not probabilities that I'm making. These are probabilities that are created they're derived from the prices of the options. That's why we call these derivatives. These are prices that are derived from, is information that's derived from the option itself. The very next day, lo and behold, the market only moved $2.50. Coincidentally, less than the $2.65, or maybe not so coincidentally. And what happened? Volatility had dropped here from 30 to 20. Even here, it dropped from 28 to 19. So those prices went from 265. This one increased a little bit, but this one went from 225 to 115. At the end of the day, what happened was that it's $4,000, which is, what, 8% of the 50, maybe a little bit more. You get half of that credit. You can just close the trade. You keep half of that credit in one day, and you're out. Just from the change in volatility. This is a known. This is something that we know happens. When earnings hits, volatility collapses. How do we use that information to our advantage? Option pricing tells us something. How do we use that information to our advantage? That is our goal in trading, is to be to use information effectively and to stack the probabilities in our favors as much as possible. Too much of stock trading is really just guessing, in my opinion, where stocks can move one direction or another and people are not even really sure what's going on. I'd much rather agree with the option market than disagree with the stock market. So this is a condor trade where I essentially agreed with the market. It was telling me that, look, there's a 1.7% chance this is going to be in the money here, a 2.2% chance it's going to be in the money here by expiration. That's what, 3%, 4% chance. So I'm looking at, let's say 95% chance that this expires worthless. I would much rather have those odds than a 50-50. And it's not me making up those odds. Yeah?
Oh, we had a question. Mike Schwartz asked, why did you use the monthlies versus the weekly options?
That's an excellent question. I didn't use the weekly option because it gives you room, because I'm trading as if it were weekly, but I'm using the monthly because the monthly gives, to get the wider range, I use the monthly in case I'm wrong, in case the market is wrong. See, frequently, if the market moves more than that $2.65 or the $5.50 of the put in the calls, and if it moves more than that, that means the market itself was wrong. And if that's the case, I want to be, I'll be okay if I'm wrong in the short term, but I'd rather be right in the long term. And in this case, I was more comfortable. I am more comfortable trading something a little further out, because maybe the next day I won't make money if I trade it weekly, but maybe by the next 2 or 3 days it'll be profitable. Typically, this is not unusual to see a trade make money overnight in an earnings play, but it's not uncommon for Google or Apple to make huge moves. And if that's the case, you want to be able to have enough room so that if it goes, if it takes off, then maybe you can wait a few days and maybe it'll pull back, and then you'll be okay. But you don't want to limit your time span for that to happen. So that's kind of our approach when we think about options. Is we want to trade, we want to get out early, we want to take our profits early. We structure the trade as if we were going to stay in longer. And so, for instance, in this particular example, it was structured that if you stayed in for 25 days, it's still let's say a 2% chance here and a 2% chance here of probability of being in the money. So that's like a 95% chance that you would not be in the money. So I did it again. Sorry. Sorry about that. So 95% chance of being in the money. That you won't be in the money. That you'll start worthless. So what I did is I said my risk reward was like this. Okay, there's 25 days left in the trade. I stay in for 1 day. I take out 50% of any possible profit I could possibly take. And I do it in 1 day. So for me, that's a great risk reward scenario. So,
Mike Schwartz asked, did you exit at that point, or did you hold it? And how do you defend it if you did hold it because it's starting to move up?
Well, I'm actually not allowed to show actual trades in these kind of presentations, but typically in this type of situation, I would just exit.
Okay.
I would exit the trade. I'd rather take, yes, you never go broke taking a profit. My whole philosophy in options has always been to hit singles as much as possible, and just, you don't have to be in the market. You're in the market when there's an opportunity. When the information is such that it's in your favor, then you take the trade. So, for instance, some people like to, I'm not a day trader. We don't day trade at Preston Crest. That's not our goal. What we try to do is we look for opportunities. There's, one of the things I like to say is, like, when somebody plays a game of chess, for instance, your goal, a strategy is not, winning is not a strategy when you play chess. Winning is what happens when you execute a proper strategy. It's the same thing with options. When you have a proper strategy, the money comes. You don't worry about, a lot of people go into trading thinking, I got to make X amount of dollars per day. I got to, this has got to be my returns per week, and this has to be just like this. If you go into it like that, it won't work. You have to exploit the market. You have to exploit probabilities as much as you can that they're in your favor as much as possible.
And we had another question along those lines from Andrew. He says, do you think technical analysis has a place in identifying points where volatility is, quote, wrong?
I found that volatility tends to be more right than wrong. Much to my dismay. Many, many times I wish that volatility was wrong, but it's usually right. So what was the rest of his question? He wanted to know what the...
Do you think technical analysis has a place in identifying points where volatility is wrong?
Oh, yeah. I just wanted to make a point about technical analysis. If you've noticed, I didn't show you a single chart or technical analysis or supportive resistance. I didn't show you anything about the stock to do this trade. That's how you have to think when you're trading options. If you start looking at charts and technical analysis, remember, every piece of technical analysis is backwards looking. The only forward-looking piece of information is option pricing. It's the only piece of information. Doesn't mean that it's accurate, but it's the only one that's actually looking forward. And it's the one that people are putting real money on the table, betting, going forward, what they think the market's going to do. Everything else is lagging. Which to me, when I had that, kind of like epiphany, it was like, oh my gosh, option pricing is really the only forward-looking piece of information that exists in the entire market, in the entire marketplace. Everything else is just looking backwards and projecting forwards. So Yeah, I mean, people try to use technical analysis with volatility. Again, I'm more interested in the difference between the historic and the implied volatility and how that plays out, because I'm looking for an edge in probabilities. And if my implied volatility, that one line is higher than the other one, if I'm a seller, I have an edge. If it's flipped the other way, if your actual volatility of the stock is higher than what's being priced in the option, you should be a buyer because you're paying cheap for the option. I just wanted to add this one idea about condors because there was a point in my first book. It was, you're never going to get a perfect trade. People like when they sell condors, they want to sell options. They say, look, I want to get as much money as I can, which is the credit. I want to get my price. I want to get my strikes out as far away as possible. And I want the least amount of time. And you never get all three. You only get 2 out of 3. Sometimes, when the market crashes, actually, you get all 3 of those, which is actually kind of fun. So trading options when the market goes down is actually a lot more fun. You make a lot more money because you're actually able to get all 3 of those. But typically, you get 2 out of 3. So when the volatility is high, you want to get a lot of credit. You want to get the best strike price, and you're less worried about time because when volatility is high, it tends to move up and down a lot, and you can make money just on the volatility changes. If the volatility is low, you want to get good strike prices, and you want less time because now you're really trading time more than you are volatility. So the iron condor, if people are familiar with it, it's for me, it's 2 trades in one. And in the best case scenario, you're trading volatility and you're trading time. So if the volatility fails, you fall back on time as a backup. So those are the kind of the parameters I use when I look at, you can't have a perfect trade, but you can have a trade that you feel good about, that you think that has a high probability, and that's what you're looking for. You don't want to be flipping a coin. As much as possible, you want to avoid flipping a coin. So that's kind of a summary of what I've been talking about since publication of my last book, is really trying to create a paradigm shift for stock traders. To try and show how you can go through an entire trade without we didn't even know what the stock was. We didn't even know what the stock had done. We didn't know anything about the stock. We didn't know anything about the company. I only told you what the stock was at the end. And you can still structure a successful trade. That, to me, is the best part about options, because the stock really just becomes an alphabet soup, the tickers. It doesn't matter. What you're looking for is opportunities to exploit. And that's, what at Press and Press, that's our focus. That's what we try to emphasize in trading the options.
So with volatility lower in the last year or 2 or so, a lot of people in our community they do a lot of iron condors and butterflies, and the low volatility has made it very difficult for option traders doing condors, especially if you like to adjust, because there's just not as much premium. Do you do adjusting a lot on your condors, or how have you adjusted?
I will do adjustments. I will try to, roll it up. In this kind of environment, what you want to, try to do is maybe make smaller trades and make more money on the smaller trades, rather than make, bigger trades and try to make, that way you have money to adjust with.
Right.
Yeah, that's kind of in the low volatility environment. I mean, this has been a kind of a crazy, as everybody knows, there's been a vertical market for the past few years, which, defies reason. But that's why you have to be nimble. If you're in this trade and you're making money, you take the money, you get out, and then you wait. And if it takes a couple of weeks for another opportunity to come up, then wait. You don't have to be in the trade all year long, all the time. That's something you want to avoid as much as possible. You want to just, exploit opportunities, get in and get out.
So when you're putting your condors on, are you looking for opportunities like spikes in volatility, for instance?
Yes, I would definitely look for a spike in volatility. I look at a number of things. I look at the VIX. It's interesting. I'll look at Bollinger Bands on the VIX because it seems to be very consistent that, if you have a spike in the VIX that breaks 2 standard deviation move up, that it will revert to the mean, which is basically just like kind of free money when that happens. The other thing that I look for, it's interesting to look at the VIX pricing. It's one of those weird things. If I can see if I can pull this up here 1 second. If you look at the VIX pricing, wait, let me just close out of this. Yeah. Sorry. So hold on. Just want to go back a little bit here. Hold on 1 second. So it's interesting that, let's see if this pulls up what I want. Well, it's not. You'll see that the VIX pricing, I'm sure you can pull it up on my wife's not working here like the way I want it to, that the price for the VIX calls and the VIX puts are, so I'm just looking it up on, honestly, I'm just looking it up on my phone because so the VIX is at 12. So right now, if you sold a put on, or it's 12.5, the put is selling with, is selling for 15 cents, 20 cents, 25 cents, the 12.5 put. But the call is selling for $1.40. So people are willing to sell naked puts on the VIX for 15 cents. Normally the prices should be about the same. When there's a big skew like that, it just shows that the people are nervous. They don't really think the VIX is going to go down much more. It's not always the case, but it's not infrequent. If that makes sense.
Yep.
Yeah.
And we also had a question of what underlying do you trade? Do you do stocks or mostly indexes?
When I do condors, I do the indexes. I do the indexes because there's a few advantages. First of all, well, unless it's an earnings play. If it's an earnings play, then you're really just trying to make it's kind of like a day trade. But if you're trying to do an iron condor, there's a few, especially the indexes, because one is they're diluted. Like the S&P 500 is diluted. It's 500 companies. So one piece of information will not affect the stock as much as it would on an index. And then the other thing is that the indexes are, they're European style options, which means that even if there's a huge move that blows through your short strike, you're not going to get exercised because European options cannot be exercised until expiration date.
Makes sense.
So that's why and plus the S&P in particular is very, very liquid. So the SPX is my favorite instrument to trade for condors, but I found that trading these kind of earnings announcements also, it gives you a sense of the logic behind options. If you can understand how that works, you'll have a better understanding of options in general. because you'll see, what kind of trades work when volatility goes up, what kind of trade works when volatility goes down. Then what do you do after the earnings come out? What kind of trade works then when you really don't know anything? Well, maybe then is a good time to put on a condor. Because after all the information's out, then there's no surprises coming up. The surprise is behind you. You know what I'm saying?
Yep.
So there's different reasons to do it. But at least you have a reason, and you have a reason that makes sense, and you're using the information the stock market's giving. The options market's giving you. It's not something that you're just sort of like, I think that, the market's going to go up or down because, I read the Wall Street Journal. So
do you have any favorite stocks that you like for earnings? Do you play the really liquid ones like the Apples and Amazons?
Apple, Google's, Amazon's, those are the best. Those are the ones that you want to do. Because first, they're very liquid. And what happens is because so many people trade them, what tends to happen is the price, it tends to be accurately priced, the options. They tend not to be, unless there's a surprise, which does happen, but it's the options on companies that are not liquid that, for instance, Apple will have, there's maybe 20 or 30 analysts who follow Apple or Google. So there's just all the information's out there. So it's very hard to beat the market. But for some smaller company, that might not be the case. The information may not be complete in the option pricing. Hope that's clearer for you.
Yep, that makes sense too. And David said, do you trade calendars? I would assume that means with earnings.
Well, that would be something you would do going into earnings. And I haven't, honestly, I haven't traded calendars that much. I don't. They look really pretty on paper, but they don't. I don't find that they really make the money that I thought they would going into an earnings situation. And it's kind of like, it's almost a volatility hedge against another trade. Like, for instance, when you're in a condor or a butterfly, you want volatility to go down. Whereas with a calendar, you want volatility to go up. So they kind of offset each other. And if you make a portfolio of options, that's a good thing to do.
Right.
So in that case, yeah. But you'd have, for instance, just like, you have scans for stocks, there are scans for options. And you can look for, which ones are good calendar opportunities, which ones are good condor opportunities. And just let the market tell you. You don't have to guess. That's the best way. Just use that
Very
information.
good. I think we've run out of questions, so is there anything else you'd like to cover before we call it a day?
Just that this is who I am. If anybody would like to get in touch with me, please feel free to call, visit our website, or email me, and be glad to, discuss what other, options, strategies. I'm on LinkedIn. It's a lot of fun. I've enjoyed it a lot, reaching out to people, and I've had a lot of people reach out to me. So, please call, visit, or email. I'd love to hear from you.
Great, and I'll put all your contact information on the blog post with the replay, so everybody can easily contact you.
Okay, outstanding.
All right, thanks very much, Michael. We appreciate your insights, and thank you very much for joining us.
All right, thank you. Take care, Tom.
All right. Thanks. Bye-bye.